So, um, if I told you to name the company that is perfectly positioned to profit from, like the intersection of ultra-secure enterprise, AI, and global energy shortages, you would probably name a Silicon Valley darling, right?
Absolutely. You'd think of some nimble, cloud native startup fresh off a Series C funding round.
Exactly. But you would be wrong.
Mhm.
Because today, we are looking at a 90-year-old Japanese legacy hardware giant that has, well, they've quietly evolved into this margin-expanding quantum computing powerhouse.
Yeah, it's a massive pivot.
It really is.
Yeah.
Welcome to the Japan Stock Podcast. For you, the retail investor trying to, cut through the PR fluff, our mission in this deep dive today is to dissect this profound transformation. Because if you miss the underlying mechanics of what this company is doing right now, you're missing one of the most fascinating strategic pivots in modern tech.
And, the market still largely prices this entity as a relic of the 1990s.
Right.
I mean, when you mention their name, people visualize mainframe computers or, like, massive dusty server rooms, consumer laptops.
Yeah, that chunky plastic hardware.
Exactly. And that historical hardware legacy completely masks the macroeconomic and financial shifts happening under the hood. So we're going to look strictly at the hard numbers, the evolving operating margins, and the geopolitical positioning that are actively reshaping their valuation.
Let's start by defining their actual footprint today.
Yeah,
Because the baseline assumptions that most people have are just wildly out of date.
totally.
If we strip away the noise and just apply the classic 80-20 rule, ignoring all those minor peripheral subsidiaries, what is the actual engine generating their revenue right now?
Well, the modern valuation basically rests on three major segments. The vanguard of their transformation, the absolute crown jewel, is what they call service solutions.
Okay.
And this is almost entirely driven by their global rollout of a platform called Fujitsu Uvance.
Right, Uvance.
Yeah. And then below that, you have hardware solutions. But we need to be clear, this isn't old school legacy tech.
Right, they aren't selling floppy disks.
No. We are talking about ultra-high performance servers, advanced storage infrastructure, 5G base stations.
The heavy-duty stuff.
Exactly. And finally, there is Ubiquitous Solutions, which covers the residual client computing devices. But make no mistake, the market is laser-focused on Uvance and the service layer.
Because Uvance is where the entire business model mathematically flips. Let's translate this shift for you guys. In the traditional IT service era, so think the late 90s or early 2000s, this company basically operated like a high-end custom home builder.
That's a good way to put it.
Right. A massive domestic bank or a government agency would come to them, and they would send like 400 engineers to just sit in a room for 2 years, designing and coding every single system from scratch.
Very bespoke.
Incredibly bespoke. But the fundamental flaw there is that your profit margins are entirely capped by how many software engineers you can physically put on the payroll.
Yeah, that resource constraint is the exact ceiling that killed the margins of legacy tech.
Right.
Every single new contract required a proportional increase in labor costs. So the marginal cost of delivering the next unit was just incredibly high.
But with this Uvance model, they've pivoted to selling high-end, pre-integrated modular smart homes. The foundation, the plumbing, the wiring, it's all standardized, rigorously tested, and just sitting on the shelf.
Exactly.
When a client needs a supply chain management system, they just configure the specific software modules required. Building a bespoke system costs millions in labor every single time. But building a modular software suite, that requires a massive upfront R&D investment, sure, but selling the 100th or 1,000th copy costs practically nothing.
Basically zero.
And that is how operating margins absolutely explode.
And we really have to look at the psychology behind that transition, too, because this wasn't some sudden visionary epiphany from management.
No, not at all.
It was a drama of adaptation forced by just brutal market realities. Their history in the legacy mainframe market left them with deep operational scars from the commoditization of hardware.
Oh, yeah. They watched their hardware margins get completely cannibalized by overseas manufacturers.
They did. But those exact scars forced them into complex software, decades of deep entrenchment in domestic enterprise systems, and critical public infrastructure, which, used to make them slow, that has hardened into their armor.
Right.
They understand the messy bureaucratic reality of massive organizations better than almost any of the nimble startups trying to disrupt them.
Which brings us to the virtual battlefield. Because if they are now selling modular, high-end enterprise software systems, they are stepping into the ring with absolute global behemoths.
The biggest companies on Earth.
Right. So as an investor, you have to ask yourself, are they trying to fight a bloody head-to-head war against Microsoft or Google in the generative AI space? Let's call that Path A.
Path A is a zero-sum game they would lose, and they know that.
Yeah.
Strategically, they have actively chosen Path B. They are not trying to outcompute the hyperscalers. They are brokering and blending.
Brokering, blending, I like that.
Yeah, their entire framework relies on a mixed technology approach. They take general-purpose technologies, so foundational models from OpenAI or Anthropic, data analytics platforms like Palantir, and they weave them together with their own highly specialized proprietary intellectual property.
But wait, I have to challenge the durability of that strategy.
Why, go for it.
Historically, being a middleman or a broker in tech is a uniquely dangerous place to be. I mean, think of the early cloud resellers who just got squeezed completely out of existence when the big players went direct to consumer. If you don't own the foundational model, isn't that an incredibly weak economic moat?
Well, it is a weak moat if you are just white labeling software.
Right.
But their moat is engineered to solve a very specific trillion-dollar problem, which is corporate terror.
Corporate terror. Wow.
Yes. Enterprise executives are absolutely terrified of generative AI. They have zero tolerance for data leaks, compliance failures, or hallucinations.
Yeah, because the stakes are so high.
Exactly. If a general AI hallucinates a catchy marketing slogan, it's funny mistake on Twitter, if it hallucinates a logistics route for a global supply chain, that is $100 million write-off.
Oh, man. Yeah.
So this company brings proprietary hallucination mitigation technology. They use advanced automated machine learning, or AutoML.
Okay, let's break down AutoML for the listener real quick. Because normally, if a corporation wants to build a custom AI tool, they have to hire a team of, 50 expensive data scientists just to manually test hundreds of algorithms.
It's extremely labor-intensive.
Right. But AutoML is essentially software that writes software. It automatically tests and optimizes those models to find the exact right fit for a company's proprietary data without that massive human overhead.
Exactly. And they run all of that through their own highly secure platform called Fujitsu Kazuchi.
Right, Kazuchi.
Furthermore, they recently collaborated to build a specialized model called Command R plus FINAC. And this is explicitly designed to operate entirely within a private, secure enterprise environment, completely walled off from the public internet.
Okay, so it's like the foundational models from the hyperscalers are like brilliant, fast-talking interns who occasionally make up facts and might accidentally email your trade secrets to a competitor.
That's a great analogy.
Right. And the Kazuchi platform is the strict, unyielding compliance officer. It sits right between the user's prompt and the LLM, scrubbing proprietary data before it ever leaves the building, and then cross-referencing the AI's output against the company's internal ERP system before the user is even allowed to see it.
Exactly. That application layer is the moat. And you have to consider the data scale here. Enterprise clients are not just asking an AI to summarize a 2-page PDF.
No.
They need to feed the system up to 10 million characters of proprietary internal data simultaneously.
10 million characters.
Yes. We are talking about decades of legal contracts, complex interwoven supply chain logistics, and highly sensitive financial records. General-purpose AI simply cannot process that volume securely out of the box. So building the secure connective tissue that allows a major bank to use generative AI without violating federal compliance laws, that is a remarkably deep moat.
It is. But maintaining that moat requires an astronomical amount of compute power. Enterprise AI relies heavily on massive data centers and complex global hardware supply chains. And that puts this company squarely in the crosshairs of global geopolitics.
Yeah, we have to analyze the global economic security landscape here impartially.
Right, just looking at the facts.
Exactly. Regardless of the political administration in power, we are seeing a definitive rising trend across all major global governments towards strict export and import regulations.
Yeah.
And this is heavily focused on dual-use technologies and advanced semiconductors.
And as an investor, you have to look at the macro energy risks tied to running those data centers, specifically concerning the United States. I mean, data centers are incredibly power hungry. They consume roughly 80 to 90% of this entire group's energy.
The financial exposure to the energy transition is massive. Current macroeconomic projections indicate that if the U.S. implements a comprehensive carbon pricing mechanism, a carbon tax could reach $140 per ton of CO2 by 2040.
Wow.
And it could escalate to $210 per ton by 2050. Now, if we apply those projected tax rates to their current operational footprint, our simulation indicates this could directly hit their bottom line by 15 billion to 15.3 billion yen.
Wait, let me just repeat that. 15.3 billion yen.
Annually, yes.
I mean, when you pull back and look at the sheer scale of global compute demand, that number illustrates how energy costs could completely wipe out software margins if they're left unchecked.
Absolutely.
And this isn't just a hypothetical U.S. regulatory problem either. Right here in Japan, the rising feed-in tariff, or FIT levy, which is designed to fund renewable energy infrastructure, that's projected to add roughly 3.9 billion yen in operational costs by 2030 alone.
Yeah, balancing the capital requirements of a massive AI expansion against rapidly inflating global energy and regulatory costs, that is the ultimate friction point.
Honestly, it seems borderline delusional to think they can just absorb these massive compounding energy and regulatory costs globally without crushing their profitability. Are they just, like, hoping electricity gets cheaper?
No, they aren't relying on hope, and they aren't relying on standard power-hungry computing architecture either. This is where they play their strategic wild card, which is the Fujitsu Manaka processor.
Okay, let's look at the mechanics of the Manaka processor. Why is a new chip a wild card when NVIDIA already owns the entire market?
Because governments in Europe, across Asia, and domestically in Japan are waking up to a terrifying reality. They are entirely reliant on a handful of US-based monopolies for the critical infrastructure needed to run their digital economies.
Right, and they don't like that.
Not at all. There is a massive coordinated push for sovereign security and defense. So the Manaka processor is currently in development as an ARM-based open software CPU. It is engineered from the ground up for ultra-high performance combined with radically lower power consumption.
Oh, so they are directly attacking the energy constraint.
They're attacking the energy constraint and the geopolitical bottleneck simultaneously.
That's smart.
And they're not trying to build this ecosystem in isolation. They are forming strategic hardware and software partnerships with key global players like Supermicro, AMD, and NVIDIA. It is a highly calculated play to capture the specific subset of the market that demands sovereign, energy-efficient AI infrastructure.
Okay, so we have the shift to modular services with Uvance, we have the enterprise compliance mode with Kazuchi, and the energy-efficient hardware play with Monaka.
Yep.
How does this actually flow through the engine room? Let's connect these operational variables directly to the metrics retail investors actually care about: earnings per share and return on equity.
Well, by transitioning to an offering-based business like Uvance, they essentially break the mathematical limit on their revenue growth.
Because they're not tied to headcount anymore.
Exactly. When you decouple revenue from headcount, your gross margins on incremental sales expand significantly. When operating margins structurally elevate across the entire enterprise segment, you inherently generate a higher return on equity.
Let's visualize what that actually looks like on the balance sheet, because the first half of 2024 data is just staggering. Their free cash flow hit 48.2 billion yen.
Yeah, it's huge.
That is a year-over-year increase of 13.5 billion yen. Put it in perspective for a second. There are publicly traded tech companies that take a decade to generate that kind of cash.
Oh, absolutely.
This company effectively generated a whole new mid-sized company's worth of free cash flow in just 6 months. And they did this despite an environment of somewhat sluggish corporate IT demand, purely through currency tailwinds and vastly improved operational leverage from their software shift.
It's remarkable leverage.
Add to that a fortress-level balance sheet, 3.38 trillion yen in assets, standing against only 1.48 trillion in liabilities.
It is an incredibly robust financial position, but, for long-term valuation, accumulating cash is kind of irrelevant if management misallocates it.
Right.
The critical metric is their capital allocation strategy.
Exactly. Retail investors get burned all the time by legacy companies that generate huge cash flows and then just hoard it for a rainy day, or, waste it on vanity projects just to check corporate governance boxes. So what is management actually doing with the money?
A rigorous critique of their internal cash flows shows really aggressive reinvestment. They are directing heavy, sustained funding into advanced R&D that pushes the very boundaries of computation.
Like what?
Well, for example, they recently developed a 64-qubit superconducting quantum computer.
Wow.
And this isn't science fiction. This is applied research aimed at solving complex optimization problems like global supply chain routing or deep drug discovery that traditional supercomputers simply cannot handle efficiently.
And they are also spending heavily to fix their own house.
Right.
They are rolling out a massive internal digital transformation. a global ERP system called the One Fujitsu program.
Yes.
They're using their own cash to digitize and streamline their internal operations, forcing the very efficiencies they sell to their clients onto themselves.
Exactly. The metabolic rate of management has fundamentally changed.
Yeah.
The CEO recently stated publicly that he is never satisfied with the status quo, and to force operational speed, they are completely reorganizing the entire Japan region starting in April 2025.
That's a huge move.
It is. They are abolishing the old geographic silos and splitting the domestic business into specialized industry verticals. So there's a dedicated enterprise division handling manufacturing and retail, and a public division handling finance and social infrastructure.
Which means their sales teams and engineers actually have to become deep domain experts in specific industries rather than just being like regional generalists.
Right.
And we are seeing management introduce ruthless internal competition to locate resources optimally. Just look at their retail sector. Instead of forcing all retail software solutions to be developed by the legacy teams in Japan, they are actively leveraging their German subsidiary GK Software to drive retail offerings globally.
Yeah, that's a key shift.
They are acknowledging that Europe might be a faster, more innovative launchpad for certain products than their own headquarters. That proves management is actively hunting for ROE improvements wherever they exist.
It is a textbook turnaround of corporate culture. However, professional prudence demands that we look for the cracks.
Always.
We cannot just cheerlead the margins. We have to identify the execution risks. And to be honest, there is a glaring blind spot here.
Okay, let's talk about the downside risk. Where is the vulnerability?
The vulnerability lies in the gap between raw technological capability and actual user adoption. The CEO himself has acknowledged a critical lack of scale and experience at the consumer-facing application layer. They possess elite technology, the quantum frameworks, the secure Kazuchi AI platform, the Monaka processor development. But raw technology is not a product.
Right. Building a revolutionary microchip is fundamentally different from building a software interface that thousands of stressed corporate employees actually want to use every day.
Exactly.
Legacy enterprise companies are notoriously terrible at user experience. I mean, they traditionally design software to impress the chief information officer who buys it, not the entry-level employee who has to, click through it all day.
That is the exact trap. They critically lack the agile, highly iterative experience required to rapidly turn raw tech into seamless, intuitive services. An investor analyzing the stock really has to weigh this execution risk.
Right.
Can they package this brilliant back-end architecture into application layer services that clients readily adopt before nimbler, aggressively cloud-native competitors figure out the compliance piece and beat them to the punch?
Yeah, because the balance sheet is a fortress, but the connective tissue of rapid service development is still basically unproven on a global scale.
Exactly.
And that is the ultimate tension at the heart of this thesis. They have built an incredibly defensible fortress, armed with quantum research and massive cash flows, but now they have to prove they can launch a successful, highly profitable offensive from it.
They really do.
As you evaluate this company for your own portfolio, we will leave you with this final thought to mull over. Over the next 3 years, as generative AI shifts from being a shiny, terrifying novelty to just a basic, boring commodity that every business relies on, will this company's heavy, entrenched legacy enterprise armor be the exact thing that saves them from the commoditization trap?
Or will it be the very weight that sinks them?
Exactly. That's the billion-dollar question. Thank you for joining this deep dive on the Japan Stock Podcast. We'll see you next time.